Hi, I'm David Leese from Avantt Consulting. Last week I was talking to an executive who was starting to do some work for one of the biggest private equity firms in the nation. They had just acquired a company. And they know that they're going to sell the company in 4 or 5 years, or they're going to do an IPO. So he said to me, David, I know that Avantt Consulting helps companies improve their valuations over time. So let me ask you the question. What is the difference in what should be focused on if you're going to go for an IPO versus if you're going to go for a sale or getting a major shareholder through an investment? And I said, well, actually, there are some similarities, but there are some significant differences. So, with any company, there are 4 or 5 things that a company has that contribute to about 80% or more of their market valuation. Now, that's different from your core competencies that you need to have, like manufacturing and new products and et cetera. It's different than your core competencies. It's what are the 4 or 5 value drivers that cause outside investors to pay better than market average multiples for your company. So there are 4, each company will have typically 4 or 5 value drivers that will contribute to 80 or 90% of the valuation of that company. So let's take an example, and one of the examples I used with him. Let's start with financial performance. So financial performance is important, right? If you look at an IPO, however, financial performance may take a backseat to other factors, and we'll get into those in a minute. And as a matter of fact, the financial performance of companies going for an IPO could be actually terrible. If you think about companies like Uber and Slack and Amazon and all of those, Amazon in its early years, the financial performance and the ratios looked just terrible. So your standard valuation metrics, when you do a standard valuation, would have looked awful, right? So versus if you're going to be selling to an investor or looking for debt financing, the financial performance is absolutely critical, right? EBITDA is critical, return on assets, your balance sheet, your income statement, all of those things, return on assets, whatever your critical measures are for your industry, all of those things are absolutely critical. So there's one significant difference. Now, it doesn't hurt when you're doing an IPO if you've got if your financial performance looks absolutely fabulous, right? Let's take another valuation driver, and that will tend to be something called story. Now, let's reverse that a little bit. When you're selling or you're looking for an investor, story is important, but it may not be one of the 4 or 5, right? You've got a great story about your product or your place in your industry or how well you're known in the industry or your new products or your technology or whatever. So you've got a great story, but it may not be one of the 4 or 5 that's contributing to that 80 to 90% of the value of the company in the marketplace, right? And on the other hand, an IPO story typically is just about everything, right? It's a huge, huge thing, whether it be Amazon or in the case of Uber, right? Who's reinventing how how individuals move from one place to another. And now, as they move into transportation for goods, now they're starting to touch logistics and reinvent logistics. So story here, in the case of Uber, is absolutely huge, right? And you can think about all of the other startups that you're familiar with where story was absolutely the driver. Story, and then obviously the numbers behind all of that. So that's a second big differentiator. Third, oftentimes in an IPO will be management team, right? And here, what we're talking about in management team for an IPO is people who are very bright. They typically have done it before, and they've got a great history behind them. And so the management team becomes really, really critical when you're doing an IPO. In terms of star power, for instance, you may even go out and hire somebody and pay above market for your size company in terms of sales or whatever. That is much higher than you would normally, but you're looking for some star power. So that's another one. When you're doing a sale or you're looking for investors, what's important about management there is depth. And actually, it's kind of the inverse. Here, what you're looking for is, can I cut off the top layer of management, who, by the way, may not survive an acquisition by a strategic buyer, for instance. And so can I do without the top 1, 2, 3, or 4 guys, or the top shareholders, or whatever? Can we do without those? Is there enough bench strength in the management team so that a new buyer can function and still grow? Remember, financial buyers will be looking for and are buying a future revenue stream where the management team, by and large, will stay in place, but not necessarily. So they're looking at depth as well. A strategic buyer is looking for management depth for sure, because likely the top people will not survive very long after the acquisition. So again, a big difference in the perspectives. So those are a couple of the things, a couple of the differences between going for an IPO or looking for an investor or selling. So thank you for taking the time. If you're looking at us anyplace else other than Avantt Consulting, go on over, and we've got lots more things on valuation drivers on our website. Thank you.